Welcome to the 5-Minute Prime Podcast. Quick, actionable tips to master personal finance and real estate investing. In just 5 minutes a day, we'll help you build wealth and achieve financial freedom.
Hey, Prime investors, Martin Maxwell here, and welcome back to our special two-part series. Last week, we established a powerful new mindset. A high-yield bond is just a value-add real estate deal in disguise. We learned the why, how your skills in underwriting tenants, collecting rent, and forcing appreciation are directly transferable. You now have the mental model. Today, we're building the playbook. This is the how. How can you actually invest in this space? And even more importantly, what can this seemingly separate market teach us about the health of our own real estate investments? This is where the research phase of our Prime framework gets a powerful new tool. We're going to learn how to listen to the bond market's chatter to make us smarter, more prepared real estate investors. It's time to get tactical. Let's get into it. The idea of buying individual corporate bonds can be intimidating. Just like a first-time investor trying to buy a 100-unit apartment building, it requires a lot of capital and deep expertise. But just as you can easily buy a share of a real estate investment trust, or REIT, you can easily buy into a diversified portfolio of hundreds of high-yield bonds with a single click. Here are your primary tools. Option 1, ETFs and mutual funds. The REIT approach. This is the simplest, most liquid, and most popular way to get started. You can buy an exchange-traded fund or ETF right from your regular brokerage account. The two biggest and most well-known tickers in this space are HYG, the iShares iBoxx High Yield Corporate Bond ETF, and JNK, the SPDR Bloomberg High Yield Bond ETF. The analogy here is perfect. Buying a share of HYG is like buying a share of a giant commercial real estate REIT. You instantly own a tiny piece of hundreds, even thousands of different properties. In this case, bonds issued by different companies. Your risk is spread out across a vast portfolio, and the day-to-day management is handled by professionals. This is the definition of a passive investment. Option 2, business development companies, BDCs. This is a slightly more specialized tool, but it's fascinating for real estate pros. BDCs are companies that lend money directly to small and mid-sized private businesses, the kind that are too small to issue public bonds. Think of this as a private lending fund, almost like being part of a private debt fund that you can buy on the stock market. You're still on the debt side of the deal, but you're investing in the off-market space. BDCs often have even higher yields than public high-yield bond funds, but they can come with more complexity and different risk factors. For 99% of investors starting out, the ETF or mutual fund approach is the smarter, safer, and more efficient play. It gives you immediate diversified access. Even if you invest passively through a fund, it's crucial to understand how the pros analyze a potential deal. And I want to reinforce this point. The process mirrors real estate due diligence perfectly. When you're looking at a big apartment syndication, the sponsor gives you an offering memorandum. When you're analyzing a bond, you read the prospectus. Both documents are the deal Bible. They detail the property, the company, its financials, the management team, and most importantly, the risks. In real estate, you do a deep dive on your anchor tenant's financial statements. A bond analyst does the exact same thing with a company's balance sheet, income statement, and cash flow reports. They're asking the same fundamental question you are. Can this tenant pay the rent? And what about location? A great location provides a real estate asset with a durable competitive advantage. In the business world, this is called an economic moat. The company's unique, sustainable advantage over its competitors may be a powerful brand, a patent, or a network effect. A company with a wide moat is a more reliable tenant. My point is, you already have the skills. You're not learning a new language. You're just applying your existing expertise to a new domain. This is the most critical segment for us as real estate investors. The high-yield bond market is a sensitive barometer of economic health and, more importantly, investor risk appetite. It often sends signals months before we see them play out in the slower moving real estate market. Here are the two signals you need to watch. Signal 1, credit spreads, the fear gauge. The spread is the extra yield that high yield bonds pay compared to a risk-free U.S. Treasury bond of the same maturity. It is the clearest measure of fear in the market. When spreads are narrowing or tight, it means investors are confident. They feel good about the economy and are willing to accept less extra return for taking on risk. It's a risk-on environment, which is generally positive for real estate values too. When spreads are widening dramatically, it's a massive red flag. It means investors are getting scared and are demanding much higher returns to lend to risky companies. This risk-off sentiment almost always precedes an economic slowdown or downturn, which ultimately impacts property values and rental demand. So, what's the reading today? As of mid-October 2025, credit spreads are relatively tight, sitting around 3.04%, which is below the long-term average. This tells us that despite concerns about inflation and Fed policy, the bond market is not currently pricing in an imminent recession. Investors are still willing to take on risk. Signal 2. Default rates, the vacancy rate. The default rate is simply the percentage of high-yield companies that fail to make their payments. It is the bond market's equivalent of a portfolio's vacancy and eviction rate. Rising default rates are a clear sign that the economic foundation is cracking under the surface. It means more tenants are going out of business. So, what's the forecast? According to recent reports from Moody's, the high-yield default rate is projected to remain below 5% this year and is expected to fall to under 3% by 2026. This is well below the historical average during recessions, which can hit double digits. This reinforces what the credit spreads are telling us. While there might be pockets of stress, the experts are not forecasting widespread corporate failure right now. A sudden spike in this projection would be a major warning sign for us. My point of view is this. Watching these two metrics, credit spreads and default rates, is like having an early warning system for the real estate cycle. It's an invaluable addition to the research phase of your prime framework. Let's wrap this series up. The world of high-yield bonds isn't a distraction from real estate. It's a powerful complementary tool. It offers a liquid way to generate strong income, a great way to diversify your portfolio, and most importantly, it provides a real-time sentiment reading on the health of the economy. By learning to read these signals from the bond market, you add a sophisticated new layer to your investor toolkit. You become a more informed, more prepared, and ultimately a more successful investor, capable of seeing the bigger picture. Your challenge today: go back to that ticker symbol from last week, HYG. This time, I want you to find a simple chart of its price over the last 5 years. You will see a significant drop in its price during 2022. That drop happened as the Federal Reserve began its aggressive interest rate hiking cycle. It's a perfect visual of how sensitive bond prices are to interest rate policy, a force that profoundly impacts our real estate world as well. Connect that visual in your mind to what happened with real estate transaction volume and prices during that same period. The parallel is undeniable. Thanks for joining me on this deep dive. I'm Martin Maxwell. Keep learning, stay strategic, and keep building one smart move at a time.